series on demystifying Dalal Street, unveiling stock market needs in potatoes. Welcome back, all, and many of our participants, I think, were the same as the international webinar. So, I welcome you all, and I invite Srimati Minija Abraham to preside with over the functions.
Respected Principal, distinguished resource person, dear colleagues, dear participants from various colleges, and dear students. I am here to welcome you all to the second webinar of our webinar series on demystifying the Dalal Street unveiling stock market meat and potatoes. It's a pleasure for me to welcome our dearest principal, Dr. Kannan V, who has always encouraged us to organize such programs. Being the principal, he is very busy. In spite of his busy schedule, he is here with us to inaugurate the webinar. On behalf of all the participants, the college, the department, and on my behalf, I welcome you, sir.
Thank you.
We have a distinguished professor and academician, Dr. Zubair T, for handling today's session. He is a faculty of the PG and Research Department of Commerce, Government College, Kodenseri, Kozhikode. He is here with us to enrich us on the stock market basics. On behalf of all the participants, the college, the department, and on my behalf, I welcome you, sir. I welcome all the faculty members of our college to this webinar. I welcome you all. I also welcome the coordinator, Sri Vince Thomas, who is here with us. I welcome you, sir. I welcome all the participants from other institutions to the webinar. I thank you all for your strong support and being a part of this and as an active participant. On behalf of the college and the department and on my behalf, I welcome you all. Last but not the least, I welcome all the students of our college who has been contributing to the webinar series from the very beginning. On behalf of the college, the department, and on my behalf, I welcome you all. Once again, I welcome you all to the webinar. And I invite Dr. Kannanvi, our principal, to inaugurate the webinar and deliver the inaugural address.
Thank you, Dr. Minija Abraham. I'm here to inaugurate the second webinar conducted by the Department of Commerce. As I mentioned earlier, the department is one of the important departments in our college, and I'm happy to say that they are actively participating in conducting the webinar academic activities. And as mentioned by the head of the department in this session, all the participants who participated in the first webinar is also here. That indicates the success of the program, which has been conducted by the Commerce Department. I congratulate all the faculty members, especially Vince Thomas, the coordinator of this webinar, for conducting such wonderful academic activities on behalf of their department. I congratulate all the faculty members and students who worked behind this webinar for making these webinars or conducting academic activities in a well-behaved manner in our college. Regarding the topic, I'm happy to see that the faculty member, the resource person for this seminar, webinar, is one of our members. That means one of the faculty from Government College, Kodenseri. I am really happy to see such resource person, because it's very rare to see a resource person from our departments, and I'm very happy to see the resource person. He is also from our department, Dr. Jubaiti, Assistant Professor of Commerce, Research Department of Commerce, Government College, Kodenseri, Kozhikode. Regarding this topic, I'm from science background. I don't know about the topic. I'm not a person to talk about the topic, and it is regarding the basics of stock market. I, as I learned, stock market uh, determines the economics of the economy of the country, so that each and everyone should have a basic knowledge in this particular topic. Let the seminar shed light into the shed light in deeper areas of this topic. And I wish all the success. And with these words, I declare the webinar is inaugurated. Thank you all. Thank you all. Thank you.
Thank you very much, sir. We have with us Dr. Jubair T, who is an NSC and SEBI certified stock market trainer. He is a research supervisor in University of Calicut, having teaching experience of more than 10 years. He is a renowned resource person in the area of banking, insurance, business environment, marketing management, international business, financial market, etc. So we have a very potential resource person with us here. I invite you, sir, to deliver your talk on demystifying the Dalal Street, unveiling stock market meat and potatoes. Welcome, sir.
Thank you. Thank you. Am I audible?
Yes, sir.
Yes, sir.
Okay. Respected principal of the college, Dr. Kannan, HOD of Commerce, Eliama PJ, coordinator of the webinar, Vince Thomas, Dr. Minija, and other dignitaries, teachers, and my dear students. This program is planned primarily for the degree students, but now I recognize that some teachers and postgraduate students and some students from outside Kerala were also joined for the program. However, I would like to discuss the basics of stock market. I'm not going to the theoretical aspect of stock market. I'm going to the practical aspect of stock market. What is stock market? How to invest in stock market, how to open account in stock market, what are the basic things to be borne in mind while investing in stock market, and what are the do's and don'ts in investing stock market, etc. Okay, so let me start my presentation. Is the screen visible? Is the screen visible to you?
Yes, sir.
Yes, sir. Yes.
Okay. So our topic is the basics of trading and investing, or basics of stock market. So I am going to discuss the basics of stock market with respect to Indian stock market, which is regulated and controlled by Securities and Exchange Board of India. I am a recognized stock market trainer of the Securities and Exchange Board of India. Only two recognized stock market trainers are there in Kerala, and I am the one of the stock market trainer of SEBI. So I'm just going to discuss the preliminaries of stock market. That is very important, and the practical aspects of the basic practical aspects of stock market. So let me start from the term savings and investment. What is the difference between saving and investment? What is the difference between saving and investment? Anybody can say? Anybody can say? What is the difference between saving and investment? If we set aside a part of our income for our future needs, it's called saving. If we kept a part of our income for our future needs, it is saving. For example, if we kept some money in money box or kept some money in our savings bank account, all these are savings. So we are keeping this money for our future needs or immediate needs. But the investment is entirely different from saving. In investment, we are investing our money in certain assets or instruments with a view to get good return from it. So our main aim is not to set aside that part for our future needs, but to get a good return from it. So the investment is made in certain assets and instruments with the objective of getting high return. Okay. Then what are the investment avenues available for us? As far as an investor is concerned, what are the investment avenues that are available? Primarily, the first one is the bank deposit, particularly the time deposit. There are two kinds of bank deposits, time deposits and demand deposits. Time deposits are deposits in which the money is deposited for a fixed term. Time deposit consists of fixed deposit and recurring deposit. And the other type of deposit is demand deposit. Demand deposit is a deposit in which the deposit is repayable on demand. The current account and savings account are the examples of demand deposits. So the time deposit, that means fixed and recurring deposits, are the basic type of investment. What are the advantages and disadvantages of a time deposit or fixed deposit? The one advantage of fixed deposit is it assures a fixed rate of return to us. It assures a fixed rate of interest. Previously, the fixed deposit account give you an interest of 6 to 8%, but now only 4 to 7% of interest is available for fixed deposit account. Another importance of time deposit or fixed deposit is the low risk. Fixed deposit is low risky. All fixed deposits, all bank insurance corporation. Now in the last budget, our respected finance minister proposed to raise this ceiling to 5 lakh. So it is a low risky avenue. Then we can get loan against the collateral of a fixed deposit. Then deposit insurance facility is available. Then flexibility in tenor. We can invest in fixed deposit for a period from 7 days to 10 years. Okay, so there is flexibility in tenor or terms. Then what are the disadvantages? The main disadvantage of fixed deposit is no flexibility to access fund. We can access fund only after the termination of a fixed period or the completion of a particular period. Before that, we can withdraw money, but we will not get the guaranteed interest. Okay, and the second one is low return. That means the return generated from a fixed deposit may not be sufficient to cover inflation. As far as an investment is concerned, it must be able to cover the inflation, at least inflation. But today's fixed deposit is not able to cover even inflation. So the return is very low. Then the second investment is the gold. Gold is the one of the most important investment, international investment, most liquid investment. The first advantage of gold is its liquidity. That means we can convert it into cash at any time. But during the period of COVID crisis from January to June, it is noticed that the gold lacks liquidity. At that time, we were unable to sell the gold. So the liquidity of gold was challenged during COVID pandemic. Then second one, we can consider the gold investment as a jewelry come investment. We can use the gold as a jewelry at the same time. It serves the investment tool. Okay, and there are a number of disadvantages. It is not a passive investment. That means it does not generate regular income for us. Gold investment does not generate regular income for us. The capital appreciation is there, or it is very difficult to store. If we want to store gold with some lockers, we have to pay huge amount as locker rent. Otherwise, it is not protected. So it is very difficult to store. And the price fluctuation is the another risk or another limitation. Then the next one is the real estate. That means the investment in property, land, etc. There are a number of advantages and disadvantages of real estate. Generally, the real estate is considered as a hedge against inflation. It can be able to cover the inflation return. And also it can be pledged to get a loan, etc. Number of advantages. But there are number of disadvantages too. The first one is the illiquidity. We can't convert these real estate property into cash as and when required. So illiquidity is the first problem. Then high transaction cost. We have to pay a lot of transaction cost for transferring this property. Then lack of marketability is the another one. We can't sell it at the time when we need. Then need of huge amount of investment is needed. We can't invest 1,000 rupees or 10,000 rupees in real estate business. We need a huge amount of money for real estate investment. And the next one is life insurance. Is life insurance an investment? Can we consider life insurance as investment? The answer is no. Life insurance is not an investment. Life insurance is a security cum saving tool. There are two kinds of life insurance. The basic life insurance like a whole life policy or endowment policy, and the next one is the term insurance. It is a new type of insurance, term insurance. It is like a motor insurance policy. There is no saving. It is not a saving instrument. It will give you protection only. At the same time, a whole life policy or endowment policy give you both protection and saving. That means it guarantees to pay a fixed sum of money after a particular period. It guarantees you to pay a fixed sum of money to you after attaining a particular age, or it guarantees to pay a fixed sum of money to your legal heirs when you dead. So it is called a life insurance. So it is serve as a saving tool cum protection tool. At the same time, there are some value added products of life insurance. For example, equity linked saving schemes. Equity linked saving scheme. A part of your investment or a part of your policy amount will go to the stock market or debt market, and the remaining part goes to the insurance market. So this type of policy is also available, and this policy is the combination of both investment and protection, not saving and protection. Then come to the stock market. Stock market is an alternative to all these investment, which can eliminate the majority of the limitations of the earlier investments. But it has a one major limitation, that is the risk, high risk. Number of advantages, number of benefits, but one major limitation, that is the risk. There are different categories of stock market investment. We can invest in a mutual fund. We can invest in equity. We can invest in debt. We can invest in derivatives. Derivative is a separate segment of the stock market. Derivative is a contract or instrument whose value is derived from an underlying asset. It is the contract to buy or sell an underlying asset at a future price on a future date. So this is the not time to we have not time to discuss the meaning and other aspects of derivatives. Now I'm going to discuss the equity element of stock market. Now I'm going to focus the equity element of stock market. Then why stock market? Why stock market? Why does the stock market is important? The answer is, the first one, it is regulated. Stock market is a regulated one. That means the stock market is regulated and controlled by the Securities and Exchange Board of India, which is functioning under the Ministry of Finance. Each and every activities of the intermediaries, the investors, are watched by this regulator. So it is a protected market because it is regulated by a regulatory body, strictly regulated by a regulatory body. And the second one, flexibility in investment. You can invest any amount in stock market. If you have 100 rupees, only 100 rupees you have, but you can invest this 100 rupee in stock market. So flexibility in investment, any amount you can invest in stock market. But the investment must be white money. No black money can be invested in stock market. That means that stock market investment can be done only through bank. Then marketability is the next one. Marketability, the secondary market. Stock market has two phases, primary market and secondary market, two elements, primary market and secondary market. The primary market is the market where the first-hand issue of securities is done. That means the securities are issued for the first time in primary market. Hello? Hello? Securities are issued for the first time in primary market, and the second-hand securities, that means the securities once issued in primary market is sold in, bought and sold in secondary market.
Second time.
So the second, candidate, please mute. Participants, please mute your mic. If you have any query, you can ask at last. Okay. Then the third one is the marketability. That means the stock market ensure you marketability. That means you can sell your holding in secondary market or stock exchanges through a stockbroker. Anytime you can sell your shares. Okay, so it ensures marketability. And the third one is liquidity. That means you can convert the holding into cash easily. Marketability and liquidity is different. You can convert your holding into cash, or the shares can be converted into cash within a period of 2 days. That means once you sell your share today, you will get your money within 2 days. Then high return for high risk. Stock market give you high return if you are a literate in stock market, if you invest carefully, but you have to bear huge risk. Stock market involves high risk, but you must be able to manage this risk. There are a lot of strategies to manage the risk and to make your stock market investment safe. Stock market give you return that cannot be awarded by any other investment avenues, but you must be very careful. You must analyze, you must be able to analyze the market, you must be able to analyze the stock, and you must have some literacy in financial aspects. And the next one is the business, not gambling. Stock market is not a gambling. Stock market is business. Once you purchase the equity share of a company, you are the shareholder of that company. You are the owners of that company. You are doing business, or the management of that company is doing business for you. It is a part of business. It is not gambling. Then, have you heard about Sensex and Nifty? Sensex and Nifty. Sensex and Nifty are the benchmark indices of India. Sensex is the benchmark index of Bombay Stock Exchange. Bombay Stock Exchange is located in the Dalal Street. That is why the topic is given in that line. Okay. And the Nifty. Nifty is the benchmark index of National Stock Exchange of India. These indices act as a barometer of the economic activities of a country. It acts as a barometer of the economic activities of a country. When these indices moves, that movement reflects the economic condition of that country. When it is going up, we can conclude that, or we can infer that the economic activities of the country are going well. Then, can you double your money in stock market? It's a question. Can you double your money in stock market? Is it possible? My answer is no. Don't come to stock market with an intention to double your money within a period of 1 or 2 years. There may be instances to double the money, but you don't target stock market as an investment avenue to double your money. Stock market give you a decent return if you are patient. If you can invest for long term, it will give you a decent return, but don't expect a 50% or 100% return within a period of 1 year from stock market. Many investors came to stock market for short-term trading and day trading with an intention to double the money. And the majority of these day traders and short-term investors fails. So, don't target stock market as an avenue to double your money. But look at some examples. Look at this example. It is a basic technical chart of a pharmaceutical company in India. The name of the company is Laurus Lab Limited. Name of the company is Laurus Lab Limited. The price of Laurus Lab Limited on 2nd December 2019 was 68 rupees, 68.36. 2nd December 2019 was 68 rupees. And the share value on November 27 is 316. 316, that means 5 times. If you invest, if you invest rupees 1 lakh in December 2019, you will get, or your investment value became 5 lakh, around 5 lakh in 2020. So it is a single case, or I said there are some instances. There may be some chances to double your money. Look at another example. It is another company, Future Lifestyle Fashions Limited. The price of Future Lifestyle Fashion Limited on 5th December 2019 was 404. 404. And the price on 27th November 2020 is only 94 rupees. So you have to note this point also. That means the performance of the stock may not be in accordance with our expectations. Sometimes it will give you a better return. Sometimes the stock may go down. Nobody can predict the stock market. Nobody can predict the future of a company. Nobody can predict the price of a share. But one thing, if you invest in a good portfolio, if you are ready to wait for a long period, then the stock market will give you a decent and attractive return. Look at another example. Tata Consultancy Services Limited is one of the major IT company in India. Tata Consultancy Services Limited, TCS. Look at the figure from 2004 to 2020. The stable growth, we can see the stable growth of share price. So this type of companies, we have to identify this type of companies. If you invest this type of companies for long term, you will get a better return. So that is the mantra of stock investing. So don't target stock market as a place to double your money. It is a place where there is huge possibility of huge return, and at the same time there are chances of loss. It involves a huge risk too. Then how to invest in stock market? How to invest in stock market? In earlier periods, the foreign institutional investors were the main investors in Indian stock market. The majority of the gains derived from Indian stock market were catched by these foreign institutional investors. But now number of individual investors came into the scene. Then how to invest in stock market? There are two ways to invest in stock market. The first one is mutual fund, and the second one is stocks or equity or debt. That means the stocks. So you can invest stock markets directly, either directly or through mutual fund. So let me take mutual fund first. What is a mutual fund? Mutual fund is your best friend. Mutual fund is nothing but is your best friend. If you are not financially good, if you are not a financial literate, if you are not aware of Indian securities market, how to analyze the market, how to analyze a share, or how to invest in stock market, you can depend your best friend. You can entrust your money to your best friend who is an expert in the market. If you are not a literate person, not a financial literate, then you can depend your best friend who is an expert in the market. You can entrust your money with him. He will invest for you. Mutual fund is your best friend. Mutual fund consists of fund managers who are experts in the market, who are able to analyze the market, who are always spend time for analyzing the market, for analyzing the stock. So they analyze the market. They will find the appropriate stock in accordance with your objective and invest your money in these stocks. So the mutual fund is a best friend of you if you are not an expert in stock market. Then theoretically, what is mutual fund? It is a collective investment scheme. That is, what is collective investment? Collected pool of money from many investors. Mutual fund collect pool of money from many investors. Then invest in securities. This money is invested in securities. Securities means invested in debt, equity, money market, gold, etc. Then investment in accordance with the investment objective. That is very important. There are a lot of mutual fund schemes. You have to select your mutual fund scheme very carefully. You have to select a mutual fund scheme in accordance with your objective. If your objective is your retirement life or the marriage of your daughter, then you have to select a particular type of fund. It is better to select a hybrid fund. It is a combination of equity and debt. Sometimes an equity fund may be suitable to your objective. So each and every fund may have certain objectives. So you have to select the mutual fund scheme in accordance with your objectives. So then equity, debt, hybrid, solution oriented, and others. SEBI classified mutual fund into 5 categories. Equity, that means the mutual fund which is invested in equity fund. There are different kinds of equity funds: large cap funds, mid cap funds, multi cap funds, sectoral funds, equity linked saving schemes, etc. Then the second one is the debt fund. There are different categories in debt fund too. Conservative debt fund. That means the majority of the money is invested in debt and some low portion is invested in equity. And the balanced fund is there. That means 50-50 in equity and debt. Then aggressive, debt fund may be of different types such as overnight fund. Overnight fund, money market fund, liquid fund, gilt fund, etc. Debt fund may be of different category. Overnight fund for a period of an overnight or one day. Money market fund invested in money market instruments. Gilt fund invested in government securities, etc. I said the hybrid fund. Hybrid fund invest both in equity and debt. In hybrid fund, there are conservative fund. That means the majority part is in debt. And the balanced fund is here 50% debt and 50% equity. And aggressive fund, the majority of the money or the pool of money is invested in equity. And there are some solution oriented funds. That means the fund for retirement, fund for children's education, funds for children marriage, etc. And there are some other funds, other category, or the fifth category is other. It consists of some funds such as index funds, fund of funds, etc. A unit of total investment is allotted to the customer. In the case of mutual fund, you will get a unit of the total fund, but not the share. The share is held by the custodian of the mutual fund. It is purchased in the name of a trust. And the unit is given to you. Generally, a unit is issued at a price of rupees 10. And the value of your mutual fund unit can be checked every day after the closing of the market hours. So you can check your NAV, net asset value of your unit each and every working day after the market is closed. Then mutual fund for who? First one, it is suitable to all kinds of investors, irrespective of the knowledge in the market. It is suitable for all kinds of investors. Whether you are a financial literate or illiterate, you can invest in mutual fund. But it is best suitable or particularly suitable to financial illiterates. If you are a financial illiterate, your knowledge is limited in financial market, then it is better to invest in mutual fund. And also it is suitable to the financial literates with no free time for analysis. If you are a financial literate, but you are very busy, you have no time to analyze the market. You have no free time to analyze the market and analyze the share. In such case, you can opt mutual fund. So mutual fund is suitable to all kinds of investors, but it is best suitable to financial illiterates, then financial literates with no free time for market analysis. Then what are the advantages of mutual fund? Mutual fund offer you a lot of advantages and benefits. First one is professional management. Mutual fund consists of professional management. Mutual fund consists of fund managers who are professionally sound, who are well experienced, who have enough knowledge in the market, who are always analyzing the market. So they are professionally managed. Then second one is low cost. That means they invest in shares in bulk quantities. Therefore, the investment cost is lower. And the next one is diversification. They will not invest your money in a particular security. They invest money in a diversified securities in different sectors, in different companies. Diversification reduces the risk. Diversification is the one of the strategy that can be used to reduce the risk. Don't put your eggs in one basket. It is a phrase. Have you heard that sentence? The diversification avoids such type of loss or risk. And the next one is low minimum investment. You can invest money ranging from rupees 500 to lakhs or 1,000 or lakhs of rupees. So minimum 500 rupees you can invest in mutual fund. Then flexible. It is a flexible type of investment. You can select number of options are available. Debt funds are available, equity funds are available, then lump sum funds are available, SIP, systematic investment plans are available. A lot of options are available for you. So you will get flexibility in investment. These are all the main advantages. A lot of other advantages too. But the main advantages are these 5. Professional management, low cost, diversification, low minimum investment, flexibility, etc. Then requirements to start mutual fund. How to start a mutual fund investment? What are the requirements? First one, application. You have to apply in prescribed format. You can apply offline or online. Now the mutual fund companies and distributors allow you to fill up applications in online. So you have to make an application first. Then know your customer documents. Now it is mandatory to submit know your customer documents for stock market investment. Either it is a mutual fund or it is a stock market direct investment. Then what are the documents that can be used to comply with the know your customer requirements? First one is the ID proof. A document with your photo, a photo identity card. You can use voter's ID card, you can use PAN card, you can use passport, you can use Aadhaar card, etc. Aadhaar card is not mandatory. And the second one is address proof. You have to submit a document as a proof of your address. If your ID proof also contain address, Aadhaar card can serve both the purpose of ID proof and address proof. Then only one document is required. Then bank account details. You have to submit the details of your bank account. Why it is? What is the need of bank account? Because you can't invest in stock market in cash. You have to invest through banking channels, and the money will be repaid only to your bank account. So you have to submit the details of your bank account to enable the online transfer of money, or to submit your or to invest your money as check. Then no need of demat account. In order to invest in mutual fund, demat account not required, but it is optional. If you have a demat account, you can store all of your holdings under one account and you can manage your entire holding as one. So there are a lot of advantages and disadvantages if you kept your mutual fund investment in demat account, but demat account is not compulsory for mutual fund investment. Then PAN card, not needed for investment up to rupees 50,000 per year. If you invest in mutual fund if you invest 50,000 or less than rupees 50,000 in a mutual fund scheme per year, then there is no need of PAN card. but the PAN card will be required when the mutual fund company repays your money. But at the time of investment, you need not take PAN cards. Then how to invest in mutual fund? First one, purchase directly from mutual fund company. You can purchase mutual fund products directly from mutual fund company. You can purchase mutual funds both online and offline mode. You can visit to the branches of mutual fund company and you can purchase mutual fund units offline. Or you can visit to the website of mutual fund companies. You can purchase mutual fund units online. Then purchase through distributors. There are a lot of distributors such as brokers. You can invest in mutual fund scheme through your brokers too. But you have to pay more charges, more commission or brokerage may also to be given for mutual fund investment if you done it is through brokers. Then mutual fund utilities are there. Number of centralized and decentralized utilities are there which enable you to invest in different mutual funds. Then there are two basic categories of mutual fund investment. One is lump sum investment. You can invest a lump sum amount in mutual fund. Either you can invest a lump sum amount in mutual fund. Otherwise, you can invest as SIP, systematic investment plan. That means a fixed amount regularly for a fixed period. The SIP starts from a minimum amount of rupees 500. Then, after mutual fund, let me come to the direct investment. Direct investment in stock market. If you are a financial literate, if you have studied security analysis and portfolio management in your graduation or Indian financial system in your graduation, then if you are able to analyze the market, if you are able to monitor the developments in the market, if you are able to analyze the quality of a stock, then you can go for direct investment. What is direct investment? Investment in stock market directly. We can classify the direct investment into two categories, debt and equity. You can invest either in debt or in equity or both. So let me come to debt market. What is debt market? Debt market consists of, first one, government securities. These are issued by the government. These are issued by the government. It consists of government bonds, treasury bills, etc. So these are securities issued by government and they are called gilt-edged securities. They are highly secured instruments. Highly secured instruments, government securities. It consists of government bonds, dated securities, treasury bills, etc. Then the second one is the debentures. Debenture is an acknowledgement of the debt of the company. So it is issued by companies. So they are debt instruments issued by companies for long term. It carries a fixed rate of interest. It guarantees you a fixed rate of interest like fixed deposit. But it gives you much higher rate of return while compared to a fixed deposit. And the next one is bond. Structurally, there is no difference between debentures and bonds. Structurally, there is no difference between debentures and bonds. But in India, the debentures issued by the government and public sector undertakings are called bonds. But theoretically and practically, there is no difference between debentures and bonds. And there are money market instruments too. Money market instruments consist of call money, short notice money, treasury bills, then certificate of deposits, etc. So money market is the market for short-term funds and the capital market or stock market is the market for long-term funds. Okay, money market is the market for short-term funds up to a period of 1 year. Then let me come to the equity market. Direct investment in equity. How can we invest in equity? There are two ways to invest in equity. First one, initial public offering. That means investment in primary market. There are two elements of stock market. First one is primary market and secondary market. Primary market is the market where securities are issued for the first time. The securities are issued by companies directly. In order to manage the issue, the company will appoint a merchant banker. And the merchant banker is the institution which manages the public offer. Initial public offer or IPO. In IPO, the shares of the company are offered to the general public. Initially, the company may be started by some promoters. And after a certain period, they plan to develop the company. They plan to establish more branches. They plan to extend their activities into foreign countries. So they may be in need of huge money, and this money cannot be raised from banks and such other institutions. In such a situation, they may approach SEBI to sanction an IPO. That means to subscribe or to invite public to subscribe the shares. So you can invest your money in primary market. That is called initial public offering. It is a straight ahead method. Then requirements to apply for an IPO. Who can apply for an IPO? What are the requirements to apply for an IPO? You must have a bank account. You must have a bank account because no money can be invested in cash. You can invest money only through check or online transfer or through a UPI mechanism, etc. So it can be done only through banking channel. So you must have a bank account. Then a demat account with the DP. You must have a demat account. What is demat account? Demat account is an account which is opened for keeping our securities in electronic form. Previously, the securities was issued. The securities were issued in physical form, in paper form. But now the securities are issued in electronic form. So we have to keep these securities in some demat account. This demat account is offered by depositories. Depository is an institution which holds securities in demat form. There are two depositories in India, NSDL and CDSL. These are two institutions in India which offer depository services. But there are a lot of depository participants. Depository participants are the members of these depositories. Almost all banks and brokers have taken membership in depositories. They are the members of DP. They are called depository participants. The depositories, NSDL and CDSL, does not deal with the customers directly. We can open our demat account with a DP. That means depository participant. It may be a bank. It may be a broker. So you have to start a demat account with a depository participant, with a broker or with a bank. Then online banking facility. You must have online banking facility or UPI facility. It is very important. You can apply to an IPO only through online banking or UPI. Have you heard about UPI, Unified Payment Interface? That means Beam, Google Pay, Phone Pay, Paytm, etc. offer you UPI facility. That means you can transfer money with the help of a mobile application. Any bank account can be connected to these applications and you can transfer money. So you can make an IPO application only through either online banking or UPI can be used to make such application. Clear? So requirements to apply for an IPO is a bank account, then a demat account and online banking or UPI facility. Then requirements to start demat account. Who can start a demat account? You must have a PAN card. You have to take a PAN card for investing in stock market to take a demat account. Then a bank account. You must have a bank account. Then you must submit identity proof and address proof. As I told earlier, the KYC requirements must be fulfilled. Okay. Then can a demat or trading account open for a minor? Answer is yes. If you are a minor, you can start a demat or trading account, but only through your guardian. You can operate this demat account only after attaining your majority, but you can open a demat account with your guardian, and the guardian may transfer the shares to your demat account, because a minor is not capable of entering into a valid contract. Then how to apply for an IPO? How to apply for an IPO? There is a mechanism for the application of IPO. It is called application supported by blocked amount, ASBA. The name of this mechanism is application supported by blocked amount, ASBA. In earlier times, the application was done through banks. We have to pay the application money first. Generally, the application money may be the 50% of the value of the share. So in earlier days, we could pay the application money first to the company. And if the shares are allotted, we will get the share. If the shares are not allotted, then the company will refund your money. But now, this IPO process is done through application supported by blocked amount. That means nothing will be transferred to the company at the time of application. If you apply for shares worth rupees 15,000, suppose the price of a share is 1,000, you are applying for shares, you are applying 15 shares, 15 into 1,000, 15,000. Then this money will be blocked in your account. If you make an IPO application through ASBA, this amount will be blocked in your bank account. You cannot withdraw that amount, but you will get interest on that. That is the mechanism of ASBA. So your money will be blocked in bank account. Then after allotment, the message will be passed to the bank whether you got the allotment or not. If you get the allotment, then the money will be transferred to the account of the company. Then if you do not get the allotment, if you didn't get the allotment, then that blocking will be removed and the money can be available for withdrawal. It is the mechanism of ASBA. So at the time of application, the money will not be transferred to the bank account of the company. It will be transferred to the account of the company only if you get allotment. Otherwise, it will be kept in your account as a lien amount. Clear? Then the second one is, then another point to be noted here, through online banking. You can apply for an IPO through online banking. If you have online banking facility, how to open an online banking facility? There is no need to visit your bank branch to open an online banking facility. You can open your online banking facility at your home. In order to open an online banking facility, if you have a bank account, if you want to open online banking facility, then you can open it online. You must have a debit card in your hand and you must know the CIF number, the customer identification number of the bank that will be available in your passbook. So if you have the CIF and a debit card, you can register online. Okay, so go to the online banking website of the bank. There is an option in it to register new accounts. So you must have online banking, or you can apply through online banking. If you have online banking or if you register for online banking, then there is an option of ASBA or stock market application, e-services. In State Bank of India, it is under e-services. ASBA services will be there. So you have to enter your demat account details for the first time. Only once you need to enter your demat account details. Then it will be stored in the online banking account. Then the IPOs or initial public offer and available for the period will be displayed. Generally, an IPO will be open for a minimum period of 3 days and a maximum period of 10 days. Whenever the IPO is open, it can be seen in the online banking account under ASBA services. So you can make your application online. And the next method is through brokers. You can make an application through brokers. Brokers will give you online and offline applications. You can fill the details and you can pass it to the broker. In such a case, the broker will pass this application to the bank. The bank which provide you the application or the application of IPO is called self-certified syndicate bank. The banks which offer you IPO facility is called self-certified syndicates bank. And the broker will collect the applications of the clients and these applications are handed over to the bank and the bank will enter the details. Then at the time of entering the details, a notification will be sent to your UPI account. That means you have to mention the UPI ID. There will be a UPI ID for every Google Pay, Phone Pay, Bheem Pay, etc. And SBI Pay, etc. Each and every UPI application, you can see a UPI ID. So you have to mention this UPI ID in the application. So when the bank enter the details, and a notification is sent to your UPI application, your Google Pay, your Phone Pay, whatever be. So you will see the notification. If you click on notification, the Google Pay or the UPI application will ask you to authorize the payment, authorize to block the amount by entering an OTP or such other means. So you have to authorize through your UPI application. Then the required amount will be blocked in your account. It is the another mechanism to apply for IPO. So IPO applications can be made either through online banking or through brokers or through UPI. Then direct investment, the second way. The IPO is the first way. It is the investment in primary market. And there is another investment option, that is the investment in secondary market. Which is secondary market? Secondary market is the stock exchanges which enable you to buy and sell securities that you have purchased earlier, that you have purchased, that you have subscribed in IPO or that purchased in secondary market. So secondary market is the market which ensure the marketability and liquidity of securities. Secondary market cannot be separated from primary market. Primary market cannot exist in the absence of secondary market. If there is no secondary market, primary market will not exist. Why it is so? We will not purchase any securities that cannot be sold. We will not purchase any security or asset that cannot be encashed. So we are subscribing to the shares of companies in primary market or IPO because we have an opportunity to sell it in secondary market or stock exchanges after it is listing. So there will be a clause. There will be a clause in the IPO that the shares will be listed in a particular exchange on a particular day, generally after 1 or 2 weeks. So in every IPO, there will be a condition or there will be a guarantee from the part of the merchant banker that the share will be listed in a stock exchange. There are a lot of requirements to list a share in stock exchange. The stock exchange will allow to list shares only if the company satisfies number of conditions prescribed by SEBI. Then after fulfilling this condition, all these conditions will be fulfilled before making IPO. And thereby it is guaranteed that the share will be listed in that stock exchange. Okay, so it is the secondary market that enable you to sell your holding that you have subscribed in primary market. So you can buy and sell securities freely. Requirements to trade in secondary markets. How to trade in secondary market? How to buy and sell shares? You must have a bank account. You must have a Demat account with the DP, as I told earlier. You must have a trading account. For IPO application, a trading account is not required. But in the case of secondary market dealings, secondary market transactions, you must have a trading account with the broker. You have to open a trading account with the broker. Then So there are three types of accounts which are required for stock market operations: a bank account, a demat account, and a trading account. If you want to invest in stock market, if you want to buy a particular share in secondary market through stock exchanges, you have to transfer your money from bank account to trading account. Then after purchasing of the share, the demat form or the dematerialized share will be go to the demat account, or the share will be transferred to demat account in dematerialized form. If you want to sell the share will be taken back from demat account to trading account and it will be sold. And the money will be transferred to your bank account. That is the mechanism. Now certain banks give you a 3-in-1 account. Certain banks allow you to invest in stock market through a 3-in-1 account because they are the members of stock exchange. That means when they have broking license, they are also depository participant. They are also members of depository. So they will offer you 3-in-1 accounts. That means you can open a bank account, demat account, and trading account in one organization. Otherwise, you have to open a demat account and trading account with a broker and a bank account. Then a power of attorney. Power of attorney is the right given to the broker to buy and sell in favor of you. So if you give a power of attorney, it will authorize the broker to buy or sell on behalf of you. But it is not compulsory. It is not compulsory. There are a lot of brokers. Stock brokers are there. Some brokers insist power of attorney and some brokers does not insist power of attorney. Instead, you can use many other ways. Power of attorney is required only for online trading. Power of attorney is required only for online trading. If you make your trading through online, through applications or website, you need power of attorney. But certain brokers like Upstock offer you to trade without power of attorney. In this case, a T-pin generated is used. A T-pin is to be generated and that pin can be used to sell your share. To purchase a share, there is no power of attorney is required. But to sell shares online, you need a power of attorney. Power of attorney is a form. There are some statement which authorizes the broker to buy and sell in favor of you. So you have to fill up the details and you have to sign the power of attorney and you have to send the power of attorney physically to the broker. But it is not compulsory. It is needed only in the case of online trading. If you conduct trade through phone, email, etc., there is no need of power of attorney. Then trading platforms. You can buy and sell share through the website of stockbrokers or through the applications provided by the stockbroker. A mobile application. All stockbrokers are now providing trading platforms. That means mobile applications to buy and sell share. Buying and selling of share is so simple. You can buy and sell share in a single click. There is no difficulty. There is no serious procedure to buy and sell. You can click on stock. There will be two options, buy, sell. If you want to buy, click on buy. Then ask which price, which quantity. You have to enter the details, price, quantity, etc. Then buy. There are different types of orders. I'm not going to the details of that. Okay, so there are some trading platforms which enable you to buy and sell securities. Then how to start stock trading or stock market investment? So you have to open a bank, demat, and trading account. You must have 3 accounts. Then study the preliminaries of stock trading. That is very important. If you want to invest in stock market, it is very important. You must be a literate in stock market. You must study the fundamentals of stock market. You must be able to analyze the market. You must be able to analyze the stock. You must be able to evaluate the parameters of a stock. You must be able for fundamental analysis. You must be able for technical analysis. Then only you can invest in stock market. So study the preliminaries of stock trading. There are a lot of opportunities to study the fundamentals of stock trading. In the last month, the SEBI started an investor awareness program in Kerala, and it is just started in Kerala and in India. It consists of a series of lectures which enable you to master in stock market and to invest confidently and to invest confidently. And there are a number of tutorials, recognized tutorials and study materials available. Don't depend on unauthorized materials and unauthorized classes. Please rely on authorized sources. There is a website of SEBI, investor website of SEBI. Number of materials are available. You can study with these materials, or you can register for a class under the SEBI's investment awareness program. You can contact me, and I shall give you the details of the investment awareness programs. But currently, it is not available to the students. It is for investors. And there are stock market trainers in each and every state. You can get the list of the stock market trainers in SEBI website. Smart trainers. You will get the details. That means name and email number, name and email ID. If you want to attend a class, you have to approach or you have to send an email to the email ID of the stock market trainer of your respective state. You will get the list from the SEBI website, investor website of SEBI. So study the preliminaries of stock trading. Then fundamental analysis. Fundamental analysis, that means the fundamentals of the economy, fundamentals of the industry. It consists of three analyses: economy analysis, industry analysis, and company analysis. We have to analyze the condition of the economy, whether it is growing or diminishing, etc. Then we have to analyze the industry. That means if you want to buy the share of a battery company, then you have to analyze whether the batteries have a huge scope for the coming 10 years. Then only you can buy. If you found that the batteries have huge scope in the upcoming years, then you can buy a battery stock. So you have to analyze the industry. Then you have to analyze the company. That is very, very important. You have to analyze the company. You have to analyze the share. You have to select a good quality stock with the good fundamentals. Then pick a share to invest. After analyzing the company, after analyzing the stock, you have to select a share to invest, and you have to include it in watch list. Brokers allow you to include the selected shares in watch list. So you can observe. You can observe this watch list. You have to observe. And it is better to invest when the market is down and the share price is down. So you have to wait. You have to watch this share to select an appropriate or to get an appropriate timing to invest. Then add into watch list, look basic technicals. Then buy and sell at appropriate timing. Buy or sell at appropriate time. Then stock market timing. Stock market is open from Monday to Friday. No trade in Saturday, Sunday, and public holiday. Normal time from 9:15 a.m. to 3:30 p.m. But there are some pre-market session from 9 a.m. to 9:15. Then post-market session from 3:40 to 4. 3:40 to 4 p.m. When do you get money? If you sell your share on Monday, it is the trading day or trade day, then you will get money after 2 days. The first day is the Tuesday and the second day is Wednesday. So you will get your money in second day. It is called a T+2 settlement. That means trade date plus 2 business days. If you are trading through a local broker or a full service broker, there are two types of brokers: full service brokers and discount brokers. Full service brokers have many branches in all areas. If you want to open a Demat account, you just call a full service broker. They will come to your home and the application will be collected from your home. And they will train you to trade in stock market. They will give you all support. Branch-wise support is available. Number of branches are there. And they will guide you in tax planning, in financial planning, then mutual fund investment, and some other areas. They will give you research reports every time, which type of shares that you can buy, recommendations. They will give you recommendations. At the same time, they are charging huge brokerage, high brokerage. And the second option is discount broker or online broker. They will give you an opportunity to trade online. The full service broker offer you both online and offline trade, but the online broker give you a chance to make, buy or sell online. But they are charging very less brokerage. Full service brokers charge a fixed percentage of your investment, but the discount brokers charge a particular amount, 10 rupees or 20 rupees, which whatever be the investment. If you invest 1 lakh, 2 lakh, 5 lakh, 10 lakh, only 20 rupees brokerage. The number one broker in India, at present, the number one broker in India is Zerodha. Number one is Zerodha. It is a discount broker. It is an online broker. So online brokers gain much popularity in today's scenario because they are charging less brokerage and they offer improved or better trading platform or the same type of trading platform while compared to full service brokers. So you will get your money within 2 days. But in the case of discount brokers or online brokers where there are a lot of customers, it may take 1 more day to get your money credited in your bank account. But in the case of a full service broker, you will get the money immediately after the settlement. That means T+2 day. Then equity investment process. It consists of opening an account, equity selection. Then you have to wait for appropriate time. Then you have to build a portfolio. That is very important. Sector and segment weightage is a lot of mistakes committed by investors. Some of the investors select a particular stock only. That means IT stock only, pharma stock only. It is not recommended. Your portfolio must have sector and segment weightage. That means you have to select stocks from different sectors. You have to select large cap stocks, medium term stocks, and small cap stocks, mid cap, large cap, small cap, etc. Then you have to select shares from different sectors. Then the monitoring, you have to watch the progress of the market. Don't look at stock market every minute or every hour. You have to monitor, you have to read, you have to understand, but don't follow stock market in every minute, every hour, etc. There may be some emotional bias from the part of you, and that emotional bias may lead to great loss. And the taxation is the another one. You have to pay tax if you gain from stock market. The taxation, the stock market gain can be classified into two: short-term capital gain and long-term capital gain. If you gain anything by selling shares which is held for not less than 1 year, which is held for less than 1 year, it is a short-term capital gain. You have to pay 15% tax of that gain. Then if you hold securities for more than 1 year, then it is a long-term capital gain. The taxation rate is only 10% for that. Then how to select a share for analysis? How to analyze? That means you have to pick up some share first. Then you have to analyze the quality of the share. Then only you can select the share. Then how to select a share? How to select a share initially for analysis? First one, what you like to buy. Look at the product that you regularly buy. And think about the company which produces that product. You can select that company and check whether the prices of whether the shares of that company is available in the market. That means you have to, or you can select the shares of those companies which produces those products that are regularly consumed by you. Then second one, business magazines. There are a lot of business magazines, online portals, etc. They will give you some recommendations. So you can find shares from that. Don't buy the shares recommended by these magazines and online sites, but you can take shares from their recommendation for analysis. Okay, you can invest only on those shares after careful analysis and research from the part of you. Then online stock market research reports, etc. can be used for getting the ideas of a stock. Then how to analyze a share? There are a lot of techniques. Economic analysis. As I told earlier, fundamental analysis consists of economic analysis. You have to analyze the economy, Indian economy, whether the economy is growing or progressing, etc. Then industry analysis. That means the industry in which the company exists. IT industry. What is the scope of IT industry in the future? What is the scope of pharmaceutical industry? What is the scope of fast-moving consumer goods in the future? You have to analyze. Then company analysis. You have to analyze the company. You have to analyze the profitability over the last 5 years, at least 5 years profitability. You have to analyze whether there is any growth in profitability. Stability of price, how the price move, you have to check. The dividend policy of the company must be analyzed. Debt equity ratio must be analyzed. A debt equity ratio of 1 or below 1 is better. It is too risky to select a company which have a debt equity ratio of 1 and above. Then price earning ratio. It is the relationship between the market price and earnings per share. Then price to book value. Sometimes the market value may be much higher than book value or intrinsic value or the actual value. In such cases, there is a scope for correction. So you have to check whether the share is undervalued or overvalued. Then only you can make investment. You have to study this price to book value. And there are a lot of other ratios too. You have to analyze these ratios that will cover in your security analysis, portfolio management, or investment management paper. You have a paper in your graduation or post-graduation you will study. Then some do's and don'ts of investing in stock market. There are a lot of do's and don'ts, but I'm presenting some important do's and don'ts of investing. Educate yourself before starting investment. Understand about the stock market. Study well. Understand the concept of fundamental analysis. Study how to analyze fundamental and technical analysis. Then only invest. Then invest early. Start your investing in your early time of your life. Start investing when you get an employment. Then only you will get a good return after 10 or 20 years when you want to construct a house or to buy a vehicle or for your dreams in your life. So invest early. Use your own funds to invest. Use your own funds to invest. Don't invest with the borrowed funds. Don't invest with the funds that is borrowed from a bank or any other institution or your friend. Invest your own funds only. Then invest more, trade less. Invest more, trade less. That means invest. Invest means you have to invest for long term. In order to get from stock market, you have to invest for long term. Trading means there are two types of trading, intraday trade and short-term trade. If we buy and sell share within the market time of the same day, it is called intraday. If we buy or sell within a period of 1 year, it is short-term trading. Then you have to reduce this intraday and short-term trading. You have to rely investment, that means long-term investment of 2, 3, or 5 years. Don't invest emergency funds. If you have a fund, there is a fund with you which is needed for an immediate purpose. then don't invest that fund in stock market. Sometimes the stock market may down in the near future. If you want the money in immediate future, don't invest that money in stock market, because sometimes you will be lost your money. You will not lost your entire money, but you may suffer loss in stock market. But in long term, if you select a good stock, a fundamentally strong stock, then you will get for the long. You will get benefited in the long run, not in the short run. In the short run, there may be some loss. So don't invest emergency funds. Then do your own research before investing. Don't depend on the recommendations of others, the magazine, stock market experts, etc. Nobody can expect the future of any company, any share, the future price of any share. Don't depend that. You do your own research before investing. Then make a good portfolio, which consists of shares from different sectors, different types of stocks, debt, equity, and different types of shares. Some are undervalued, some are fairly valued, some are overvalued, etc. So a good portfolio is very important. Each and every point that I have discussed here is very important while investing in stock market. So let me stop my presentation. It is only the basics or fundamentals of stock market. If you want to know more about stock market or to get acquainted with the methodology of stock market, you can contact me for a class sponsored by SEBI as part of the investment awareness program. Thank you. Happy investing. If you have any questions, you can ask. You can ask directly, or you can make you can post your questions in your in the chat box. You can put your questions in the chat box. One question, sir, kindly explain whether gold bond is better than gold jewelries as an investment. There are some differences in the physical investment and virtual investment. At present, there are a lot of opportunities. E-gold is there. Gold ETFs are there. But the return is the same. Return is almost the same. Well, compared to the physical gold and gold bond or ETF, etc. But this electronic form of gold will give you some advantages. That means more liquidity, then safety of investment, etc. That is all. Any other question? You can ask or put it in chat box. We can ask in Malayalam also. മലയാളത്തിൽ വേണമെങ്കിൽ മലയാളത്തിൽ ചോദിക്കാം. ഞാൻ ഇംഗ്ലീഷിൽ തന്നെ പ്രസന്റ് ചെയ്തത് കേരളത്തിന് പുറത്തുള്ള പാർട്ടിസിപ്പൻസ് കൂടി ഉള്ളതുകൊണ്ടാണ്. കുറച്ചുകൂടി സ്റ്റുഡൻസ് എന്നാൽ കുറച്ചുകൂടി മലയാളത്തിൽ പറഞ്ഞാൽ ഒന്നുകൂടി വ്യക്തമാകുമായിരുന്നു എന്ന് എനിക്കറിയാം. പക്ഷേ ഔട്ട്സൈഡ് പാർട്ടിസിപ്പൻസ് ഉള്ളതുകൊണ്ടാണ് കൂടുതൽ ഇംഗ്ലീഷ് തന്നെ പ്രസന്റ് ചെയ്യാൻ വേണ്ടി നോക്കിയത്. യു ക്യാൻ ആസ്ക് ഇഫ് യു ഹാവ് എനി ഡൗട്ട്.
ഹലോ സർ, നമ്മൾ ഇൻവെസ്റ്റ് ചെയ്യാനായിട്ട് എടുത്തിരിക്കുന്ന ബ്രോക്കർ അവരുടെ അത് ക്ലോസ് ചെയ്യും, അവരത് നിർത്തുവാണെങ്കിൽ നമ്മൾ ഡിമാറ്റ് അക്കൗണ്ടിൽ ഒരു എമൗണ്ട് ഇട്ടിട്ടുണ്ടാവുമല്ലോ, ആ എമൗണ്ട് നമുക്ക് ലൂസ് ആവുമോ?
ഇല്ല, ഡിമാറ്റ് അക്കൗണ്ട് തുടങ്ങുന്നത് നമ്മൾ ബ്രോക്കറുടെ അടുത്തല്ല. ഡിമാറ്റ് അക്കൗണ്ട് ഉള്ളത് ഡെപ്പോസിറ്ററീസ് ആണ്. ഡെപ്പോസിറ്ററീസ് എന്ന് പറഞ്ഞാൽ സെബിയുടെ കീഴിൽ പ്രവർത്തിക്കുന്ന 2 സ്ഥാപനങ്ങളാണ്. ആ 2 സ്ഥാപനങ്ങൾ പൂട്ടിപ്പോയില്ല, അത് അവിടെ തന്നെ ഉണ്ടാവും. നിങ്ങളുടെ അക്കൗണ്ട് അവിടെ തന്നെ ഉണ്ടാവും. നിങ്ങൾക്ക് ബ്രോക്കറെ തന്നെ ഈ ബ്രോക്കർ നിങ്ങൾക്ക് വേണമെങ്കിൽ മാറ്റാം. നമുക്ക് ഒരു ബ്രോക്കർ എടുത്ത് അക്കൗണ്ട് തുടങ്ങിയാൽ നമുക്ക് എന്ത് ചെയ്യാം, വേണമെങ്കിൽ വേറെ ബ്രോക്കർ അടുത്തേക്ക് മാറ്റാം. പിന്നെ അവിടെ നമുക്ക് എന്ത് ചെയ്യാം, ആ ഷെയർ പോയി പോകുന്നില്ല. ആ ഷെയർ അങ്ങനെ തന്നെ വേണമെങ്കിൽ എന്ത് ചെയ്യാം, പിന്നെ നമുക്ക് അതേ ഡിമാറ്റ് അക്കൗണ്ടിനെ മെയിൻറ്റെയിൻ ചെയ്യാം. അല്ലെങ്കിൽ വേറൊരു ബ്രോക്കർ എടുത്ത് വേറൊരു ഡിമാറ്റ് അക്കൗണ്ട് തുടങ്ങിയിട്ട് നമുക്ക് ഷെയർ അങ്ങോട്ട് ട്രാൻസ്ഫർ ചെയ്യാം, ഒക്കെ ചെയ്യാം. അങ്ങനത്തെ യാതൊരു പ്രശ്നവും അതിലില്ല. നമ്മുടെ ഡിമാറ്റ് അക്കൗണ്ടിലുള്ള ഷെയറിന് യാതൊന്നും സംഭവിക്കുകയില്ല. ബിക്കോസ് ഇറ്റ് ഈസ് നോട്ട് അസോസിയേറ്റഡ് വിത്ത് ദാറ്റ് ബ്രോക്കർ. ബ്രോക്കർക്ക് ആ ഡിമാറ്റ് അക്കൗണ്ടിൽ നമ്മൾ ഇൻസ്ട്രക്ട് ചെയ്താൽ അതിലുള്ള ഷെയർ വാങ്ങാനും വിൽക്കാനുള്ള അധികാരം മാത്രമേ ഉള്ളൂ. അതിന്റെ മുകളിൽ അവർക്ക് യാതൊരു അവകാശവും ഇല്ല. ഇറ്റ് ഈസ് കെപ്റ്റ് ഇൻ അവർ അക്കൗണ്ട്.
Okay, sir. Thank you.
Then there is a recent surge in the Sensex and Nifty indices even during the pandemic situation. Can you please explain the reason, if any? The reason is number of new investors are coming into the stock market, particularly individual investors. Now, many people think that the stock market is the only investment that can be made in this period. Stock market is the only profitable investment, and the shares and the price of the shares of companies are so attractive. So during pandemic, number of new investors, the SEBI recognized that a lot of new investors came into Indian market. And also the performance of Indian IT sector and the pharmaceutical sector is very good in this period. So the majority of the shares in Sensex and Nifty are IT and pharmaceutical shares. Then bank is also performing better. And there are a lot of reasons for this surge. And also the domestic institutional investors, number of people are now investing in mutual funds. And the domestic institutional investors are also coming into the stock market. So all these factors leads to the boom. Clear? Next, how far Sensex and Nifty reflect the state of economy? It indicates that the Sensex and Nifty is calculated from the prices of the shares of companies. If the prices are increasing, that means that the companies are performing better. The companies are earning profit. If the companies are earning profit, they will pay more tax. The shareholders will get more dividend. They will also pay more tax. And also the government will get more revenue. The industrial development, etc. So the industrial development is the indicator of the economic development of a country. That is why this Sensex and the Nifty is reflect the progress of the economy. It is only 30 or 50 share, but it is an indicator. There are certain mechanism to select these shares. That mechanism allows these stock exchanges to select shares from some industries, some sectors, etc. And it reflects the economy. Any other?
Okay, I think nobody else has any questions.
Okay, ma'am. You can proceed.
In that case, I welcome Sri Vince Thomas to deliver the vote of thanks.
Good evening, all. Respected Principal Dr. V. Kannan, our resource person Dr. Jubair T, participants from all over India, our HOD Srimati Adema PJ, and my dear colleagues. I hope all of you had a wonderful session on basics of stock market. Okay. The duty entrusted with me is to register vote of thanks. First of all, I express my sincere thanks to our principal, Dr. V. Kannan, who inaugurated the session. He has always been a source of inspiration to all our efforts. Thank you, sir. Thank you so much. Next, I would like to express my sincere thanks to our resourceful resource person, Dr. Jubaiti. Sir, you explained the meat and potatoes of stock market in a simple and lucid style. You explained almost all the basics of stock market in a wonderful, lucid, simple, understandable way. Thank you so much, sir. Thank you so much. Next, our sincere thanks to the participants from various parts of the country. Thank you all for your support and cooperation. Thank you so much, dear participants. Then I would like to register my thanks to our HOD, head of the department, Professor Eliama PJ, for her constant inspiration and help. Thank you, teacher. Next, we have a gratitude to Professor Krishna Prasad for his wonderful support and help in YouTube live streaming. Thank you so much, sir. Then I extend my sincere thanks to IQC coordinator, Professor Tawji Dominic, then colleagues of PG Department of Commerce, and all teachers and faculties of Government College Kattappana, Idukki, Kerala. Thank you so much. Thank you so much.
Okay, thank you, sir. Thank you all. Thank you, Jubaiti, sir. The feedback link has been posted. Please respond to it because that will be the base for sending you the certificates. So please do it without fail. Thank you all once again.
ടീച്ചറേ ടീച്ചറേ ഹലോ എല്ലാം ടീച്ചറേ നീ എല്ലാം ടീച്ചറേ ഹലോ
ആ പറയൂ സാറേ.
ടീച്ചറെ യൂട്യൂബിലാ ലിങ്ക് ഇട്ടേക്കാം, ഫീഡ്ബാക്ക് ലിങ്ക് യൂട്യൂബില്.
ഇട്ടിട്ട് പക്ഷേ പറ്റുന്നില്ല സാറേ, അവിടെന്നേ പറ്റുള്ളൂ, സ്ട്രീം ചെയ്യണോടത്തുനിന്നേ പറ്റുള്ളൂ.
ആണോ? എനിക്ക് എടുക്കാൻ പറ്റുന്നില്ല.
എനിക്ക് എടുക്കാൻ പറ്റുന്നില്ല.
ഇത് കോളേജിന്റെ ഇതല്ലേ?
കോളേജിന്റെ ഇതല്ലേ?
അതാണ് ഞാൻ കഴിഞ്ഞ പ്രാവശ്യം ഇത് തന്നെയാ പറ്റിയത്, ഇട്ടിട്ട് പറ്റിയില്ലായിരുന്നു. എനിക്ക് തോന്നുന്നു കൃഷ്ണപ്രസാദ് സാറിന്റെ അടുത്ത് പറഞ്ഞാൽ ഒരു പക്ഷേ ഞാൻ നോക്കട്ടെ, സാറിനൊന്ന് അയച്ചു കൊടുക്കാൻ നോക്കാം.
ഒന്നാമത് വിളിക്കാവോ? ടീച്ചറാക്കി ഞാൻ വിളിക്കാം.
ടീച്ചറാക്കി ഞാൻ വിളിക്കാം.
ഓക്കെ.
സാറേ ലിങ്ക് ഒന്ന് അയച്ചു കൊടുക്കാൻ പറ്റുമോ സാറേ? ഫീഡ്ബാക്ക് ലിങ്ക് ഫീഡ്ബാക്ക് ലിങ്ക് ഒന്ന് കൊടുക്കാൻ പറ്റുമോ? എനിക്ക് കയറാൻ പറ്റുന്നില്ല, അത് കൊടുക്കാൻ പറ്റുന്നില്ല. ഇപ്പൊ അയക്കാം. ഓക്കെ.